Don't ignore this information. There are three things that, quite frankly, the economists, the markets, and the government are all ignoring intentionally, keeping their heads in the sand so that they don't realize what we are facing. This is incredible, and it's right in front of our very eyes. I'm going to give you these three pieces of information, but also show you how to get that on your own so you could keep track of it. All of this in today's video. Let's begin. You came here for the truth, so let me unveil that for you. Starting with number 3, you can see the yield curve inversion. And what does that all mean? The bond market is signaling an imminent recession, and you can look at it on different forms, but this is what we can see with the yield curve inversion, and that is, of course, the longer dated debt is not giving the returns of the shorter. Right now, you can go out there, get a 1 month, get a 3 month, imagine a very, very short term debt product from Treasury Direct. Go there as an American, you can go there, Treasury Direct, get over 5% return on something as short as like a 1 month, 3 month, 5 or 6 month. And that is something that you don't get very often. So now we are seeing that today. Yield curve inversion is the one big indicator that should be flashing red all over the place. That is, of course, tied in with the Federal Reserve interest rate hike seen a lock for July. This is what the markets believe now is going to happen, even though they said there would actually be cuts in July. So that is starting to flip. So these things are together. And of course, that's the reason why we are seeing the yield curve inversion. It started to turn the other way. It came back to inversion. And remember, it's when it comes back up, that's when there is a problem. So we got that. We got the yield curve inversion, the bond market signaling that. A run of strong economic data has rekindled the bond rout that rattled markets and the banking system for much of the last 18 months. So this is talking about that. If you want to see it for yourself directly out of the Wall Street Journal, they get into more depth about it, what's happening with the labor market, what's going on, of course, in what they believe is happening. You got to include the fact that raising interest rates did have a dramatic effect on the banking system, including SVB, but also much bigger than that, Credit Suisse. And this is all related to the increase in interest rates going on all over the world right now at this time. Okay, so here we go. This is what we see. Now we have two giant credit ETFs hit by a $2 billion exit on hawkish Fed bets. HYG and LQD suffer withdrawals. Okay, and what's happening here? Well, as we'll talk about in another second here, I want to break down the fact that you have the immediate impact on these different assets. Okay, so these different securities that are available, well, if the Federal Reserve is going to continue to keep interest rates high, that's going to have these domino effects or knock-on effects that will be present. And you could see that in real estate. You could look at that in, all forms, the bond market and so on. And so that brings me over here to number 2. This is okay. We went to number 3. That's the bond market. Number 2 is what's happening with the jobs. Initially, we had the jobs coming out. They said, oh, wow, this is fantastic. I think it was like close to 400 or 500,000 new jobs were added. Private payrolls, ADP numbers came out. But then the non-farm payrolls showed a slowdown, a significant slowdown. They still added over 200,000 jobs, but they said that this was the slowest growth in quite a while, signaling that the job market is starting to slow. That's what they're saying. That's number 2. But in part, I need to tell you the fact that employers have announced 458,000 job cuts so far in 2023. So imagine we're about halfway through right now. Are we going to get to 1 million job cuts by the end of the year? That's unbelievable. I mean, of course, they hire at the same time. It's not all cuts. And then you have temporary workers. You have people with 2 and 3 jobs. There's a lot of things that are being skewed here. But of course, we got to acknowledge the fact that a lot of these companies are cutting jobs. You got the millions of empty jobs at the same time. This is probably, as far as I'm seeing in all my history of reading this, I've never seen anything like it. Okay, it's unusual. You have an increase in interest rates at the same time as like the most speculation we have looked at in the markets in a very long time. And that connects me to number one. The number one thing, the most important thing that you should be paying attention to right now. And before we get into it, hit that like button. I need you here on this channel. And I want to show that to you right here and now. Powell hunted by repo crisis as Fed aims to cut the balance sheet. Powell told Congress that he aims to avert a QT issue seen last time. Remember the quantitative tightening? In 2019, it caused a shortfall of reserves. So that was a huge repo crisis, was a huge problem in 2019. I covered it every single day in 2019. If you are here on the channel, I want to thank you for sticking with me this long. And now that brings me to the money mirror method. The money mirror method, which I will link to at the end of this video, so stick with me, is all about chasing liquidity. So we can measure that liquidity in different ways, and they do talk about that right here. This is part of the money mirror method. Fed's two key liquid liabilities. Powell prefers the RRP, that's the reverse repos, to drop versus bank reserves. All right, I'll break that down in a second. Now, you've got that reddish pinkish line, that is the Fed reverse repurchase facility, reverse repos. The black line is the bank reserves held at the Fed. All right. I know that's a mouthful. I know that's complicated. Just give me a second here. So we've got these reverse repos that act as liquidity. And these things were well over $3 trillion worth every single day. So imagine that's trillions of dollars sloshing around in and out of the banking system, and it's there. Doing what? Well, just imagine for a second here, you are a bank. You have a choice. You can take this cash that you have here and you can loan it out to an individual to buy a home. You could take that cash and you could loan it to a business to expand, or you could keep it at the Federal Reserve. Now, if they were keeping $3 trillion, which is extremely high historically, at the Federal Reserve, what does that tell you about the confidence of the banks in individuals and businesses? Probably not very confident, right? Well, that's what this is telling you. That's what this indicator speaks to. At the same time, you've got the bank reserves. What they hope, what Powell has said in front of Congress, most of that wasn't covered by the news. It's a little too complicated. It's really in depth. But essentially what he said was the reverse repos, that can decline as long as the bank reserves do not decline dramatically, then we should be okay. Because that's what happened in that previous cycle where the bank reserve started to go down, and it went down so far, the whole thing started to tumble. And that's why, some say that, it was so interesting that they needed some stimulus to happen. That's why they started back in September 17th, I believe it was, 2019. They actually started what became quantitative easing. We called it not QE at that time, which was very fun. But that's where we're at. So let me show you something really quickly. I want to give you the breakdown of the money mirror method. Now, it's really, it's going to look messy to you if you haven't seen this before. I think it's important. Just let me show you this. I'm going to switch my screen, and now you're getting the money mirror method. Okay? So, like I said, pretty complicated, but there are different lines here, and I want you to focus on a couple. That orange line, that's the bank reserves. Look how directly, and by the way, that pink line is the reverse repo. You can see the reverse repo has come down quite a bit from its peak, okay? And according to Powell, that's okay as long as the bank reserves, the orange line, stay, reasonable. They can't go down to where they were before. But that white line there, that is the stock market. That's the S&P. And so we have to understand that these bank reserves are extremely critical to the performance of the S&P 500 and the stock market in general. So I'm watching this very clearly. That's what the money mirror method is all about. And we don't know what's going to happen. I can't tell you what's going to happen tomorrow, but I can certainly track these indicators of liquidity. And then that's going to tell the full story as it unveils. And what I see right now is not strong at all. This is looking a little bearish, at least in the short term. Now that can change, that can flip. And then, that's the end of the story. However, if it continues in this direction, well, then that is not strong. That, and my friends, that's what it's all about. Okay, I hope you understood that. I want to break it down. I'm building out a whole program around that, and everybody in the mentorship gets all the nitty gritty details about that, just as being part of it. But for now, you understand the basics of that and why this is important. So that's 3, 2, 1. You got it all. And I'm going to tie this all in together. And at the end, I'm going to show you the money mirror method, the video that I made about it. I want to cover a couple points. We are still going through the most aggressive monetary tightening cycle since the early 1980s. And I think we're only really going to see the full impact of the tightening cycle over the next 12 to 18 months. It's important that we address this and realize that this isn't over. This is continuing. So we got to watch how it all, really starts to roll out. Well, that's one of the things that one of my members of the mentorship was talking about today, Trent. If you're listening, he was saying that I think, if these interest rates stay elevated for a period, then of course that means we're going to experience more issues. So it can withstand this part of the crisis because it's still relatively short term. It's been just over a year where they started tightening. And I do agree with this. And so we'll see. We'll see how long can they keep it up before they start cutting interest rates. Historically, they don't, once they get to that last interest rate hike, it doesn't stay there very long before they're cutting interest rates. This time around, we'll see. We will see. Okay, you've got these warnings that will come out all the time. This is Larry Summers' warning on inflation complacency, sees more bond declines. You've got, Leon Cooperman, who's saying, Nvidia is just getting out of the question, out of whack. And we do see these things, okay? We have to acknowledge that. There's no question. Things are getting quite silly in many cases. But there's other aspects that are starting to normalize. Rolex and Patek Philippe prices fall as the subdial index nears a 2-year low. This is something I've been covering often. And why? Because it shows us what's happening in the secondary markets, where, by the way, this is you have to understand this. If I go to Rolex, by the way, you can't even buy a Rolex, but if you go to the actual Rolex store, their prices have not changed. Maybe they just increase on a year-over-year basis. But this is on the secondary market. So people will go off there, they'll use their watch dealers, their jewelers, and they'll sell their different watches that they have on the secondary market. That secondary market has come back down to reality. Why? Because the froth is coming out. People are saying, you know what, I made some money on that watch. I'm going to go and sell that thing. And so that's what's happening here. You can see that people need that liquidity. You got me? Liquidity is everything. I'm going to change this to the liquidity GPS. Let me tell you, okay? And one of the strategies that people talk about, using the barbell strategy to combat inflation, deflation. This is Jim Rickards. And basically what he's saying, you could have gold, natural resources, and energy stocks as inflation hedges, with treasury notes as deflation hedges, and a healthy allocation to cash between the two ends of the barbell to provide liquidity and optionality as conditions become more clear. That's his strategy. That's what he's suggesting. You've got to do your own homework and realize, what is it? And that all depends on your personal circumstances. That's what we were talking about as I record this. That's what we were just talking about today, actually, in the mentorship. Basically, you have to decide where you are now, where you want to be, and that is going to determine what you should be investing in, not what you see at the other YouTubers out there, not what you're being told by Jim Rickards or anybody else. It's, what do I need to achieve? That might be having diversification of your income sources. That might be wealth preservation, holding real assets, other things. Okay. So I just wanted to bring you one of those perspectives. Okay. You're getting the sort of the predictions from some of these big guys, and then you're also getting what they suggest. That's that for you, because I'm trying to bring you this next level detail, which is quite frankly not covered by many people, including right here what you see with the money mirror method. Nobody's ever got into the depths like this before, and I am getting into the next levels of it myself. So when it fully releases, I can always bring more details and data to you. This is it. Just watch this video and you'll get a much better understanding of what's happening with liquidity. Check it out. Click this and I'll see you there.